Welcome to our unit number 11 in recording financial transactions. So in unit number 11, we are going to look at the receivables ledger. In the previous unit number 10, we have looked at sales day book and sales return day book. We said in a sales day book, this is a book of original entry or book of prime entry where we post credit sales. Sales return day book, it's a book of original entry where we post credit notes on sales. So in this case, once we have our original entries, the results of the original entries need to be transferred to ledgers. So results of the sales day book and sales return day book and also part of the cash book will be transferred to receivables ledger. So we are going to focus on receivables ledger. Now, in this receivables ledger, which is a T account, it has the debit side and credit side. We are going to cover the following. Number one, personal accounts for credit customers. Number two, recording transactions in the receivables ledger. When I talk of, if I go back to personal accounts, in this case, we are keeping individual records of each customer separately in its own ledger. So the key point here, ledger accounts are personal accounts for each customer. So recording transactions in the receivables ledger. How do we post the transactions in the individual accounts of customers? Number three, the age analysis of receivables. Remember, receivables is sales that was made in credit. Now, if the sales was in credit, it means the customers will pay us after a certain period of time. We need to analyze these customers to know when and how much they will pay. There is maybe a customer who owes us 1 million. We need to know the breakdown of 1 million. Maybe 20% of 1 million will be received in the first month, the second 20% in the second month. This breakdown on when the amounts will be received is shown in what we call the age analysis. And then we are selling something to a customer, and the customer is to pay us at a future date. Now, because the payment is at a future date, future may not be predicted with certainty. So some customers may default in their payments. So that default is accounted for under what we call irrecoverable debts, which is an expense. And then allowance for irrecoverable debts. Now, from experience, once you have known there is a certain percentage or a certain number of customers who default in payments, prudence states that we should now start moving forward, providing for a certain percentage which will not pay. That is allowances. Now, let's start with personal accounts for credit customers. We have said in a ledger account, we record T accounts for each customer. It's a personal account for each. So if we have Diane, there will be, as a customer, there will be a Diane T account. If we have Charles, there will be a Charles T account. So the accounts are personal. The receivables ledger contains the personal accounts of credit customers of each business, of the business. Now, an account must be kept for each customer, as we have just mentioned. And there should be a full records of how much each customer owes the business and what items the debt is made up of, and the breakdown of the debts. Why do we need personal accounts? We have seen how the sales day book, which I've just explained, provides a chronological records of invoices and credit notes. Invoices in a sales day book, credit note in a sales return day book. In addition to keeping these sales day books, which are books of prime entry, a business needs to record or have a record of how much money each individual, for it to be personal, it must be individual customer owes, and what this total debt consists of. Costs of offering credit to a customer. When we offer credit to a customer, in other words, we allow the customer to pay at a future date. Maybe we allow the customer to pay after 1 month, after 2 months, or even after 3 months. There is a cost attached to it. The first cost is interest cost of an overdraft. Sometimes because the customer has not paid, yet we need to continue operating in the business, we may be forced to go for overdrafts. Overdrafts will attract interest, which is an expense. So there is interest cost. Number 2, sometimes the customer delays in payment and we must hire somebody to follow up the payment. So that is cost of trying to obtain the payment. And number 3, sometimes we are forced to take the customer to court in order to get back our money. In that case, we have court costs. The receivables ledger, we have already summarized it. So a customer's account in the sales receivables ledger, a sales ledger is also called a receivables ledger. So it's the same thing, receivables or a sales ledger, is normally showing the debit and credit balances. The receivables ledger contains the individual personal accounts showing what each individual account receives of the and what the business of what they owe the business, what each customer owes the business. So in a receivables ledger, there is always a debit side which shows what we expect from customers, credit sales. In the credit side, we will show the credit notes that were provided, sales returns, and we will show also the cash received, any discount provided, any bad debt written off. But we will come to that. Writing a receivables, what I've just explained. There will be a T account. On the debit side, the invoices sent out including VAT. In other words, the credit sales made inclusive of VAT, if there is a VAT. On the credit side, we show any payment we have so far received from the customer, any goods that were returned, in other words, credit notes, and if there is any bad debt written out, if there is any discount allowed, it will also be shown on that other side, the credit side. Now, recording transactions in the receivables ledger. Let us now look at a more detailed example of how receivables ledger accounts are produced. So we are going to now go into details on how the receivables ledger is produced. So there is a detailed example here of a sales day book, which is a book of prime entry. There is a sales return day book and the payments that have already been received from the customer. The key point, a receivables account is an impersonal account of the customer. So here we need to show the entries as they would appear in the sales ledger or receivables ledger. So let's analyze this sales day book. So there is a customer called Ngeze, there is a customer called Leonard, and there is also a customer called Sehenis. So these are 3 different customers in the day book. And then sales return. There are other sales return. There are 2 customers. Okay, there are 2 customers, Leonard and Geze. And then payments received from those 3 customers. So in this case, if we were to draw the receivables account of each customer, we will have 3 T accounts. The first T account, the second T account, and we will have the last T account. Why am I having 3 T accounts or 3 ledgers? Because we have 3 customers. So the first customer we are trying to look at, we need to show the entries that they would appear in the sales ledger. So we have a sales ledger. Remember, you can also call it receivables, and it is which account? The first client is called Geze. There is the second sales ledger of a client called Leonard. And there is the last sales ledger of a client known as Sehenes. So in a ledger, there is the debit and there is the credit. We have debit and we have credit. There is a debit and there is a credit. Now, the transactions have clear dates provided. So let's start with the first date in a sales day book, which shows what was sold. So on 2nd April, Ngeze, we sold to Ngeze, we show the gross amount, 29. So Ngeze is the first client, 29,375. So that was on 2nd April. 2nd April. The client amount was 29. Now, we go to the next client. I want to finish with the sales day book first. Next, 4th April. 4th April, there was a client called Leonard. 4th April, Leonard, there were 2 Leonards, so I can post all of them. So 9th April also. So 4th April, we had 35,250. 35,250. So the other one was 85,187. 85,187. And then the next is back to Ngeze on 9th April. 9th April. 9th April, back to Ngeze, we have 72,850. 72,850. Next, we have Sehenes, there are 3 dates. So Sehenes, there are 3 dates. There is 10th, 24th, and 15th. 10th, 24th April, and 25th April. So let's look at the amount. Sehenes, the first one is 9986. 9986. The second one is 169,200. 169,200. And the last one is Sehenes is 28,435. 28,435. 435. And the invoice numbers must also be shown. Invoice numbers must also be shown. So, and then there is another one of Leonard. Leonard is this client here. Leonard was on 25th April. 25th April. 25th April, Leonard was again 146. 640. So we have the totals of from the sales day book. Totals from the sales day book. So let's see if there were any credit notes on those clients. So let's look at the credit note, sales return day book. Leonard, let's start with Leonard, 23rd April. Leonard, there was a credit note, 23rd April. 23rd April, there was a sales return. There was a sales return, and the sales return of Leonard was 25,850. 25,850. Next, Ngeze was 29. Say on 25th April. 25th April. Ngeze sales return. Sales return was 29. I'm reading through these. 29,375. 375. And then finally, now the payments that were received. Ngeze, we received on 7th May. Ngeze, 7th May. Cash received. The cash received was 72,850. 850. These other, Leonard was 35. So Leonard was 14th May. May, cash received. The cash received was 35,250. 35,250. And Senes was on which date? 14th May also. Cash received was 9,987. Now, once we've done that, we need now to close the accounts. We need to close the accounts. Now, how do we close the accounts so that we know the balances? We get the summations of the debits, 29,375 plus 72,850. So that gives us 102,225. So 102,225. And then we less that so that we know on the last date, we know what are the so we know what are the balance carried down. So minus 29. So these minus that. So minus 29,375 minus 72,850. So what we have, sorry, it was not captured well, 102,225 minus 29,375 minus 72,850. No, it was okay. There is no balance. So which means all Ngeze, everything that we sold to Ngeze, they settled it. So that's why the balance is 0. So Ngeze does not owe us anything as at May, not April, May. Next, we come to Leonard. We need to find if they owe us anything. So we'll have 35 plus this plus that. 35, 250 plus 85, 187 plus 146, 640. That gives us 267, 077. So 267, 07. And then we need to get the balance carried down. So it is 267 minus this minus that. So minus 25, 850 minus 35, 250. So that gives us 205, 977. 205, 975. 7 is the balance we are owed as at end of May. These are 2 months as at end of May. Now, finally, the same also on this. 9986 plus 169,200 plus 28,435. So that gives us 207,621. 207,621. You need to minus 9,987. And that gives us a balance carried down as at 30th May of 197,634. Let me explain. Remember, this was accounting for April and May. But sometimes you are asked only the balance in April. If it's only in April, don't account for the months of May. If you are asked for April, don't remove the months of May. Let's have a reflection on that. So that is what we have. And in this, I've closed the account. These ones we have there. So this is how we prepare the ledger account, so all the figures are correct. Now, a pictorial representation of what we have already talked about. Now, remember, we are in the topic receivables ledger or sales ledger. Receivables ledger, the entries we post in receivables ledger, remember, they are from the day books. So the result from invoices in our sales, the gross amount, what I was showing there was a gross amount, we debit the receivables account. Now, remember, if there was a sales return day book somewhere here, we will credit the receivables account. Sales day book with the gross amount, you debit receivables account. Sales return day book, you credit receivables account. This other one goes to the general ledger, a sales account, and maybe if there was a VAT also goes to sales account. And remember, sales is a credit entry. This is also a credit entry if we are looking at double entry. The next transaction. Now, age analysis of receivables and other reports. So remember, I had explained in introduction, an age analysis of receivables breaks down the customer balance on the receivables ledger into different periods outstanding. I had said that one customer, we may have sold to him and given a credit period. So we must do analysis of a certain customer, maybe called Leonard. There is a 30-day credit period, there is a 60 days, there is a 90-day etc. The age analysis of debt is useful to a credit controller. Remember, credit controller is the one who will be collecting the money, wishing to decide which debts to chase up. It also provides a general guide as to whether the debts of a business are being collected quickly. An example of an age analysis. So we have a client called Yannick. age analysis of receivables as at 31st January 20x8 or 20x8. So there is a customer account numbers. These are the different transaction customer names. Yeah. So we have there is a customer called BT, EA, HD, like that. Those are different customers. The total amount they owe us, and then the analysis up to 30 days, 2 months, 3 months, and over 3 months. So out of these 80,000, 64,000 is for a credit period of 30 days. The age is 30 days. 12,000 is that. So you can see it keeps on reducing. So that is a good customer. But you see, there is another customer who is not good here, who is called HD. The credit period is even, so they owe us for a longer period. So it's important to know the age analysis so that it will help the credit controller to know how to track the payments. We have said as a result of credit sales, there are some debts, some receivables which may not be collected. The customers may default. That is called irrecoverable debts. So some debts may need to be written off as irrecoverable debts because there is no real prospect or chance of them being paid. For one reason or the other, therefore, a business might decide to give up expecting payment and to write the debt off as a lost cause. So we may decide to count our losses and just move on. What causes or what are the reasons for irrecoverable debt? Number one, the customer has gone bankrupt. If the customer has gone bankrupt, we can have irrecoverable debt. Number two, the customer is out of business, but there must be evidence that the customer is out of business. You just don't assume he's out of business. Number three, sometimes irrecoverable debt can result as a result of dishonesty of the customer. And number four, customer in another country, if we are dealing with clients, international clients, and there are some forex restrictions of that country, foreign exchange restrictions of that country over this period we were to collect the money. So in those are some of the reasons why we can have irrecoverable debts. Now, how do we write off irrecoverable debts? Whenever there is irrecoverable debt, you debit irrecoverable debt as an expense and you remove it from the receivables account. So you deduct the money on the credit side of the you deduct the debt on the credit side of the receivables account and you debit receivables irrecoverable debt as an expense. So when there's an expense, you debit. And then in the receivables account, you credit. Example. At 1st October 20x7, a business has a total outstanding debt of 8,000. During the year 30th September 20x8, the following transactions took place. Credit sales, payments from various customers, 2 debts were there, account. So when we are preparing our receivables accounts, and also maybe we'll have the bad debts or irrecoverable debts, which we have said is an expense. Irrecoverable debt, we have said it's an expense. There is a debit side and there is a credit side. And then there is the sales ledger or receivables ledger. Receivables ledger or sales ledger. Receivables ledger. So we have something like that. So credit sales on the receivables ledger. So our credit sales was 50,000. So this transaction here. Payment from various. So here the cash received. The cash received is 49,000. Okay. Oh, there is something I didn't account. At 1st October, a business had total outstanding debt of at the beginning of the month. So there is the balance brought down, which I had forgot to account for it, 8,000. Okay, so let's continue. Payments are that 2 debts. So irrecoverable debt 1. There is also irrecoverable debt 2. Debt 1, debt, I'll just call them debt 1 and debt 2, of 1,800 and 4,200. 4,200 were declared irrecoverables and written off. So these 2 irrecoverable debts will be brought here, 1,800 and 4,200. It is from that receivables account. It is from receivables account. So this is even easier to close. 1,800 plus 4,200, it gives you 6,000, total of 6,000, 6,000. So this irrecoverable debt to the P and L, it goes to the income statement. It is how much? 6,000. And this other one should also be closed. This is 58,000, 58,000, and then you remove 58,000, 58,000 minus 49,000 minus 1,800 minus 4,200. So our receivables balance is only 3,000. So that becomes the balance carried down at the end of the month. Remember, we are in the topic receivables and the subtopic irrecoverable. The key point, irrecoverable debt is an expense that goes to the profit and loss. And in this case, receivables account is maintained. It's reduced by the cash received and the bad debts or irrecoverable debts. So that has already been explained there. So we have that there. So let's go to the next slide. Allowance for irrecoverable debts. Once we know clients will default, we need to be prudent and provide an allowance for these clients who will default. So allowances for irrecoverable debts may be specific. An allowance against a particular receivable or simply a percentage. So it can be a fixed amount or a percentage. An increase in the allowance. If the allowance for irrecoverable debts increases, it's an expense. And if it decreases, it's treated as an income. Example, a business commences operation on 1st July 20x4 and in 12 months to 30th June 20x5 makes sales of 300,000 all on credit and writes off irrecoverable debt of 6,000. So remember, on the debit side of the ledger is 300. There is a written off debt of 6,000. Cash received from the customers is 24. So on the credit side, we have 6,000 and 244. So at the end, the business outstanding receivables is 50,000. Why 50,000? Because this is 244 plus 6,000 is 250,000. And the receivables were 300. So debit side 300, credit side 6,000 and 244. So the balance is 50,000. What we expect is 50,000, and I've shown it there. Next. Examples to practice questions. Exams past paper questions on this topic as we wind up. Just a few questions, not all. Which one of the following combinations correctly describes the need for personal accounts? Remember, these ledgers are personal accounts. Which one of the following combinations correctly describes the need for a personal account for customers? Number one, to deal with customer queries. Yes, that is the reason why we need the personal accounts. Number two, to prepare statements. Yes, it will help us prepare statements. Number three, to monitor customer credit limits. Yes, because credit limits will also depend on the records of the customer. To match cash received with invoices. Yes, so that we know what has not been received. So all of the answers are correct. The correct answer is D. Question number two, Which one of the following is a valid reason for a debt being written off as irrecoverable? A, the customer has ceased trading. We must confirm that he has ceased trading before we write off. Number 2, the customer disputes the quality. This is not a reason. The customer has exceeded the account credit limit. That's also not a reason to write off as irrecoverable. Number 4, the customer has ceased trading, close to this, and no dividend is expected from liquidation. So here, you cannot just, because the customer stopped trading, you can still take him to court and claim the money. Unless you have explored all the channels available and you have confirmed that they cannot repay. Number 3, irrecoverable debts written off appear in the financial statements as we agreed they appear as expenses. And expenses goes to the profit and loss. As an expense in statement of financial position, expense is not in the statement of financial position. As an expense in the statement of profit or loss, that's the correct. Now, a deduction from sales, it's not deducted from sales. A reduction in the receivable, that's not true. We are looking at financial statement. This is not a financial statement. The next question. What is an age debt analysis? Remember, it's a record that shows the period of debt. Is it 30 days, 20 days, 6 months, 3 months, etc.? An analysis of the length of time customers have traded with the business. That's not true. A summary of transactions on customers' accounts. That's also not true. Number 3, the total debt on the receivables is broken down into different elements of, that's the correct one. So breakdown of the total debts into a certain period, 30, 60, or even 90. The next question. Question number 5. What is the correct double entry for write-off of an irrecoverable debt? What is the correct double entry for write-off of irrecoverable debt? We said in this one, you credit receivables account and you debit the recoverable debt as an expense. So which one is true? If you debit receivables, that's not right. It means your receivables are increasing. It is the opposite of this. Opposite of that is C. And that brings us to the end of unit number 11, preparation of personal accounts of customers. Personal accounts of customers are known as sales, are posted in a sales ledger or receivables ledger. Let us meet in our next unit, which will be unit number 12.